Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, February 15, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Another powerful day upward on our hands today. The S&P 500 was up about 1.2% today, 32 points. You can see here that the Spider finished the day at 273.03, more than $1 higher from where the 50-period moving average comes in. Previously, I discussed the fact that slightly above that 50-period moving average at 272 should be, or I thought would be, resistance to the market. It only proved to be intraday resistance. We can go down to an intraday chart and you can see here that the market gapped higher and sold off, so it gapped higher right around to where that 50-period moving average really was, slightly below it. Came back one more time, tested that 272 level right here, backed off. The Spiders backed off about almost $1.90. That's about 9 S&P handles. We built some energy, and then we forced right through it. And then that was really support for the remainder of the afternoon, and we finished on the highs. Generally speaking, that's going to be positive and bullish behavior leading into tomorrow. Tomorrow's a Friday, and without some kind of a black swan / news event, we're unlikely to see a sell-off on Friday. May see one early in the morning like we've seen this week. However, on Friday, without any kind of real catalyst behind the markets, it's unlikely that we have a sell-off. It's generally a light volume day and leading into a 3-day weekend. And that reminds me, Monday the markets are closed, so we'll resume on Tuesday. But leading into a 3-day weekend, it's unlikely we get a large sell in the market without some kind of a black swan event. So the upside is favored leading into tomorrow being Friday. That brings us to where the next target would be on the upside. And I have another red line, had to go back to the drawing board at 275.50. Comes in slightly above the 20-period moving average. And that's where I think the next area of resistance is for the market. The question is, can we get up there tomorrow? And based on the activity all week long, the answer is absolutely. All we need is a light volume day. All we need is the tone of bullish behavior, and we can absolutely reach 275.50 or maybe even slightly higher tomorrow. Now, another question that obviously comes up a lot is, was that the low and we're just going to make new highs, or is there another sell-off in this market, or what the heck is going on? Which is why we take it one day at a time. If we close above tomorrow, for example, the 275.50 level, which would be above the 20-period moving average, that would yet again bring more bullish tone into the market. But another question is that the last line of defense? And the answer really is no. The actual last line of defense for the market. And on the bullish side, we have to consider the fact that the low that we saw over here, down at 250.290, down here, we have to consider that that low will hold for a while. I don't necessarily think that's the case. However, it doesn't really matter what I think. It doesn't matter what anybody thinks. What matters is what the market is doing, and what matters to investors and traders when putting their capital to work is being on the right side of the market. You don't want to fight markets. That's the worst possible position to be in. You don't want to be the guy who's standing in the corner at a crap table betting that everybody gets crapped out. You don't want to be the guy at the don't pass line while everybody's having a half-hour, 45-minute, hour-long run where everybody's making tons of money and you continue to lose waiting for them to crap out. Therefore, you don't want to be on the short side of the market while the market's levitating higher each and every day. We haven't had a down day since we hit the bottom, and the narrowest trading range day has been about 30 points. So it's been a perpetual up move, and anybody that's been short has been in a lot of pain. So there's a time and a place, and what we do is we wait for a market signal. We wait for either a signal of a trend change, we wait for a market reversal, and a market reversal can occur intraday. That's okay, and those are the things that are taught in my course at lazyeMinitrader.com. But we have to wait for a market reversal in a situation like this Because if you're short from yesterday, you're in a lot of pain today. If you went short today and the market goes up another 30 handles tomorrow, meaning the S&P, then you're in a lot of pain. You don't want to be in that pain. You have to do two things. Number one, wait for a market reversal or a signal of a trend change, and you have to know where you're wrong. You have to have an out or an exit plan. Using strategies like that when trading is number one, prudent, and number two, keeps you out of trouble in a big way. Looking over at the IWM, look where we are. We discussed this last night. We're butting up right against the upsloping trend line that's drawn over from the long-term chart all the way down from 2011. That's where we settled today, and the chances are we probably pierce up to or trade up to these moving averages, the convergence of the 50 and the 20 period moving average right above here, and then we'll see what the market has in store. That trend line, this upsloping purple trend line, is only important based on the monthly close. So we still have a couple of weeks left for the close of February to see where the market is at that point in time. Below that line can be considered a failed breakout. Above that line could be a recapture and be very, very bullish for the market. For the IWM or the Russell 2000 Index, big line of defense is going to be all the way up here. I'm not suggesting we get to that level specifically tomorrow, but if we do get to that level and close above that level, that's going to be very, very bullish for the IWM, and that will most likely bring at minimum of a test of the old highs all the way up here. Now, one thing I found very interesting today was the VIX. So we'll look at the VIX today, and you can see here that the VIX finished mainly flat, down 13 cents. That's close enough to flat. And what's interesting is, while the S&P 500 was up 32 points today, the Dow was up 300 points, and the NASDAQ Composite was up another 112 points today. The VIX ended flat. It was down earlier in the day, and it was actually even up for a while during the day. That tells me that the VIX is finding some stability down here. If the VIX is finding stability down here, and we remain around this $19, $20, $18 level, that's going to tell us, if it's another couple of days like this, that's going to tell us that the market is most likely going to have at minimum of a pullback. This is the way the VIX is projecting what's likely to happen in the near term or into the future. There's another VIX product, VIN, which is the near-term VIX, and it pretty much looks the same. It was also down 13 cents today, so they're mirror image of one another right now. So my takeaway is mainly the same thing. If the VIX isn't going to continue lower as the market's continuing higher, I think that the market likely stalls out over the next day or two. Maybe it's right after the 3-day weekend, maybe it's tomorrow, but either way, there shouldn't be, at least in my opinion, much more upside for the market. However, it's not my opinion that counts, it's what the market is doing that counts, so we can't forget, and we always have to remember, we wait for a signal of a trend change. If the market's going to turn down and we want to be on the short side of the market, that's okay. We don't have to be the first person to the party. We just have to be there while everybody's having fun. Looking over at the transports, my second favorite leading market indicator, and the transports, look where they finished today. So the high of this red candle here happens to be 10,560 right here. And we finished the day at 10,556 and change. That's not an accident. It's not a coincidence. The market just couldn't today get through that high of this down red candle or breakdown candle. Now, it may tomorrow, but markets take it one day at a time, one step at a time. Markets will stair-step their way higher and stair-step their way lower, and resistance points on the way up and support levels on the way down certainly do play a role in where the market trades to, where the market stops, and where the market has to take a breather. Now, think about this for a minute. The transports were up 0.7% today. The Spider was up 1.4%. The IWM was up about 1.3%. The NASDAQ Composite was up almost 1.6%. So the transports were the lagging indicator today. They were the lagging index today, and they were lagging as they got stopped at the top of the red breakdown candle. While all the other markets were up considerably more on a percentage basis than the transports, they still had an opportunity all day long to push the transports higher, but they did get stopped at the high of the breakdown candle. I find that interesting. I find it fascinating. It happens like this over and over and over again. However, another big up day in the transports would take us up into the convergence of the moving averages, the 50 and the 20 period moving average. If we got up to that level, that certainly would provide a decent level of resistance to the market. Interestingly enough, another lagging index today, and while it was up, it was still lagging the major markets. Up less than 0.7%, was the XLF, which is a basket of financial stocks. We traded up into its 20 period moving average, and that's where it found resistance today. But again, even though the index was up, it was not up as much as the major indexes. That's at least something that's telling to me. So it's information I want to consider. It's piece or pieces of a puzzle. I want to make sure I've got all the pieces of the puzzle on the table, and eventually we're able to put the pieces to the puzzle together to determine what the highest probability directional move the market will make. Here's something we don't discuss each and every night, but it's something I look at each and every day, is the junk bond index. And we'll use the JNK, which is an exchange-traded fund or an exchange-traded product that tracks the junk bond index. It's the high-yield bond index. So these are bonds that have high interest rates because they're risky. And it typically, meaning this index, will typically trade alongside the equity index because high-yield bonds trade like equities in terms of the risk associated with them. So I look at the junk bond index and I see here that it's really struggling to get off the mat. And we had a nice big healthy sell-off in the junk bond index along with the rest of the markets. And what I see in this index is we're not really rallying back the same as we are in some of the other equity indexes. Now, you can't take this in and of itself and determine what is likely to happen going forward, but it's another piece to the puzzle that I like to use because if there's any trouble lurking into the future, and it doesn't have to be trouble tomorrow, it doesn't have to be trouble next Wednesday, it just has to be trouble at some point in the future, meaning the markets are typically forward-looking. It's debatable whether they're forward-looking by 3 months, 6 months, 9 months, who knows? Nobody can really tell, but the market certainly is forward-looking, meaning there are always market participants that are sniffing out something, whether it's good or bad, ahead of the rest of us. The only thing that we have to do is use the charts in order to tell us what the next likely scenario is, but there are certainly inside baseball, inside market participants that seem to have a beat on what's going to happen next. And therefore, if there are market participants that are thinking that the junk bond index is going to stay down or there's trouble in the junk bond index, that's going to promote trouble for the equities down the road. So it's just something I keep in the back of my mind. I watch the junk bond index. It can be a market leading indicator at times, meaning if I see the junk bond index roll over while equities are, let's say, somewhat flat, then I'm likely going to pay more attention at that point in time to the junk bond index than I normally would. I watch it, I know where it is, I know what it's doing, but if I see something odd, if I see it leading the market in one way or the other, I want to pay more or closer attention to it. Two of the sectors that come to mind that have been somewhat deteriorating in terms of their bond performance over the last few years have been the oil and gas sector and also part of the retail sector, the big box retailers, for example. Not all of them, but some of them. In the oil and gas sector, as oil prices rise, those companies in that sector tend to perform better because higher oil prices are better for the oil companies. But I think we all know about the retailers and how some of them have been struggling as business moves online. The big box retailers are finding it harder and harder to compete, and therefore they're making less and less money, and as a result, their bonds are underperforming. And over the last several years, we've seen several retailers go out of business, and there's likely more to come into the future. All right, enough of the soapbox, the junk bond soapbox. We'll go to the gold market, and gold didn't do much today. We saw the big up day yesterday, and today was basically a spin the wheels in the sand day. That's kind of normal market behavior. Nothing wrong with the gold market. There are likely higher prices coming. generally speaking, a big up day like we saw yesterday is the market's way of tipping its hand that that's not all there is. There's higher prices coming. When you see a big up day like that at highs, it can be an exhaustion move. You see a big down day at lows, it can be an exhaustion move. But here, we were more so in the middle of a range, and it was more of a breakout move, so there's higher prices coming as far as I can tell on the charts. We talked about it last night. Over 1,400 is probably in the cards. It's not going to all happen overnight, but nothing has changed from the analysis from last night's video. And looking over at the crude oil chart, you can see here we're approaching the 50-period moving average. We talked about the fact that 58.25 was likely going to be support for the oil market. It has been support thus far. Likely higher prices are coming. Again, nothing has changed from my outlook in the oil chart. I think this was just a pullback in an uptrend. I think the uptrend is resuming. I think just like gold, it's not going to happen overnight, but I think higher prices are coming. And I do think we will get to that $73, $74 area in crude oil if all things go to plan. So therefore, we will make new recent highs in the price of crude. So no change in the crude chart. We continue to march higher. And with that, folks, it's everything I wanted to and intended to discuss tonight. So we'll give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.